like I was saying, it's FTX. It's a safe and easy way to get into crypto.
Yeah, I don't think so. And I'm never wrong about this stuff. Never.
Well, that Super Bowl commercial really did not age well. The shocking collapse of the cryptocurrency exchange FTX this month has taken the world by storm and ruined its founder Sam Bankman-Fried overnight, as his company, a multi-billion-dollar fortune, has evaporated in just days. Make no mistake though, Sam Bankman-Fried is no victim in this situation, as it has quickly become clear to anyone paying even slight attention that the entire operation he was running was filled with fraud, negligence, terrible risk management, and general degeneracy. And the craziest part of it is that mainstream news sources are barely covering just how deep the rabbit hole actually goes, if not outright ignoring the fraudulent aspects of Sam Bankman-Fried's crypto companies. It's no secret that finance and fraud are a combo as old as time. But every so often there's an especially massive fraud event that leaves society wondering how this could possibly happen. Think of the likes of Bernie Madoff, Enron, and Theranos. I'm convinced from my research that Sam Bankman-Fried is in that league of fraud, and will soon join the ranks of those names as a textbook fraud case. In fact, when it's all said and done, I think Sam Bankman-Fried could end up making the people at Enron look like saints. If you don't believe me, John Ray III was the liquidation lawyer for Enron, and he's now the person in charge of liquidating FTX as well. In a court filing, he said, and I quote, "I have over 40 years of legal and restructuring experience. I've been the chief restructuring officer or chief executive officer in several of the largest corporate failures in history. Nearly every situation in which I have been involved has been characterized by defects of some sort in internal controls, regulatory compliance, human resources, and systems integrity. Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here. From compromised systems integrity and faulty regulatory oversight abroad, to the concentration of control in the hands of a very small group of inexperienced, unsophisticated, and potentially compromised individuals, this situation is unprecedented." End quote. If that statement doesn't just scream to you that major shady stuff happened with FTX, then I don't know what will. When the guy that liquidated Enron, the company that's literally the poster child for corporate fraud, says that FTX is the worst and most dysfunctional thing he's ever seen, you know that FTX is a complete train wreck and bound to be one of the craziest frauds in history. In this video, we'll look at the story of how Sam Bankman-Fried was able to create a multi-billion-dollar crypto empire in FTX that was built on lies and deception, and how that empire ultimately crumbled in mere days as he lost 94% of his fortune. This is the story of the rise and fall of Sam Bankman-Fried and FTX. Sam Bankman-Fried was born in 1992 to two compliance lawyers who taught as Stanford University professors. Sam would later attend MIT, where he studied math and physics, before he got his start on Wall Street in 2013 as an employee of a trading firm. By 2017, he founded a small crypto hedge fund called Alameda Research at the age of 25. During this period of time, he was trading in Alameda alongside a group of other young traders in their 20s. Alameda employed a quantitative trading philosophy and used mathematical models and data to inform all of its trading decisions. A big focus of the firm would be arbitrage trades on Bitcoin and other cryptocurrencies, where they would buy in one part of the world and sell in another to profit off of price differences across exchanges. Alameda also did not shy away from using leverage and borrowed money for its trades, and was very comfortable taking on risk to chase bigger gains. But this was not enough for Sam. He wanted to make more money, and he was unimpressed with the existing crypto exchanges. He thought many of them were glitchy and unsafe. To address this platform problem, Sam Bankman-Fried had the idea to create an exchange of his own and would launch the cryptocurrency exchange FTX in 2019. The cryptocurrency exchange also gave Sam Bankman-Fried and FTX the opportunity to create a specific cryptocurrency token for use on their platform. FTX would take this idea and run with it by creating what it would call FTT tokens. The idea behind these tokens was that if a customer used the tokens to buy and sell cryptocurrencies on FTX's platform, FTX would then offer a trading discount on these transactions. This incentivized people to own and use the tokens and to make transactions on FTX's exchange, boosting revenue for the company. However, Alameda served as the FTT token's main market maker, and along with FTX owned the majority of FTT tokens in existence. Being the main market maker meant that it was involved with most of the buying and selling of FTT tokens, which gave it a strong influence over FTT's price since it facilitated most of the transactions. This fact will become very important later on in the story. With the massive crypto bull market that started in 2020 and an aggressive marketing strategy, FTX quickly skyrocketed in usage and valuation. At its height, FTX was the second largest crypto exchange in the world and was valued at $32 billion at its peak. FTX's success catapulted Sam Bankman-Fried to become a billionaire, a media darling, and a very active political donor. The press was smitten with this millennial billionaire, who identified as a philanthropist, and talked about his belief in a philosophy of effective altruism, which boils down to a kind of utilitarianism that's focused on choosing actions that will benefit as many people as possible. However, FTX's demise would ultimately reveal that this image of wealth and philanthropy Sam had constructed for himself was a facade. In May of 2021, the crypto market was almost unrecognizable compared to just a year before. Starting at the end of 2021, the heights and excesses of the crypto market rapidly started to unravel as cryptocurrencies began to enter a prolonged bear market, as the Federal Reserve began hiking interest rates to combat inflation. The higher interest rate environment began to put pressure on more speculative assets like cryptocurrency that had thrived in a low interest rate environment where there wasn't much competition for capital and investors would invest indiscriminately. This crypto bear market finally cracked in a big way on May 9th of 2022 when the algorithmic stablecoin TerraUSD began to collapse. Stablecoins are supposed to have a fixed value and be pegged to a specific currency. They function in the cryptocurrency markets as a supposedly stable store of value for investors and traders who are holding money in the stablecoin as a sort of cash equivalent. Because of this idea that it's a cash equivalent, stablecoins are used as a relatively liquid asset on the balance sheet by cryptocurrency companies. TerraUSD was supposed to be fixed to the value of $1, but in May it lost its dollar peg and fell below dollar parity, wiping out investors as panic ensued. The collapse of a supposedly stable coin introduced broad contagion in the crypto space. This ultimately created a chain of events that led to crypto hedge fund Three Arrows Capital defaulting and entering bankruptcy in June. This then created more contagion because Three Arrows owed significant money to the crypto exchanges BlockFi and Voyager Digital, which they now couldn't pay. This then forced BlockFi and Voyager Digital to look for emergency funding or declare bankruptcy. In an effort to calm down the crypto market, which was crashing due to spreading contagion, Sam Bankman-Fried would loan BlockFi and Voyager Digital hundreds of millions of dollars to try and rescue them and stave off panic in the market. And it actually mostly worked for the time. The crypto market did calm down, and for a while it seemed like things were fine on the surface. The media was quick to crown Sam as the new JP Morgan, in reference to how he had calmed the market panic of 1907 by funding struggling companies. In hindsight, though, people should have known better after Cramer gave Sam the kiss of death by promoting that narrative. While it seemed at the time like the crisis was averted, the issue is that these events and massive loans that FTX and Alameda extended would increase the company's leverage and reduce the company's cash positions. This significantly increased the amount of risk the companies were taking on and their liabilities, which would come back to bite Sam later. Fast forward a couple months and the crypto bear market has persisted and created further problems for many crypto companies. In an ironic turn of events, the bear market would ultimately claim FTX as a victim using the imaginary token FTX had created for itself. Remember those FTT tokens that Sam Bankman-Fried had created through FTX? Like I had mentioned before, Alameda was actually the main market maker and holder for these FTT tokens, which gave it an extremely strong control over the token's price. The success of FTT that was being controlled by Sam also gave his companies a big asset on paper for their balance sheets. Since they owned so much in FTT tokens, Alameda was able to use the tokens on their balance sheet as collateral to borrow money to finance their trading activities. This gave Sam access to easy money to use as leverage at Alameda. But you might quickly be starting to see the huge problem here. The collateral they were using were tokens that they had created themselves. They could also largely control the price of the tokens since they facilitated the majority of transactions as the main market maker. In other words, they were essentially propping up their own token with thin air, and they were using it as loan collateral to boot. It was all a deception. People didn't know just yet how much of the FTT tokens were owned by Sam's companies. But this high holding of FTT meant that if Alameda somehow lost control of FTT's price, the collateral they were using to borrow money would evaporate and their balance sheet would instantly shrink. And plot twist, this is basically what ended up happening. On November 2nd, CoinDesk reported that Alameda's balance sheet was actually full of FTT tokens. They reported that Alameda had approximately $14.6 billion worth of assets, but $3.66 billion of that was unblocked FTT tokens, and $2.16 billion of that was FTT tokens being used as collateral. The fact that so much of Alameda's balance sheet was in an asset that its sister company FTX had made out of thin air spooked the markets. This is because it was now clear that the assets on Alameda and FTX's balance sheets were not as strong as investors had previously thought, since so many of them were artificially created and controlled by Sam's companies. This caused a classic run on the bank and liquidity crisis as investors scrambled to exit their FTT positions and take their money out of FTX's exchange, which created significant downward pressure on the token and financial stress for the company. FTX and Alameda might have been able to control the panic since they owned so much of the FTT in existence and was not widely distributed. But unfortunately for them, there was another major FTT holder. Binance, the largest cryptocurrency exchange in the world, had a major FTT position since they were FTX's original investor. When FTX bought back Binance's equity stake, a large portion of that $2.1 billion purchase was funded by FTT given to Binance. Changpeng Zhao, or CZ, founder and head of Binance, revealed how much FTT they had in a tweet on November 6th and announced that Binance would be liquidating their position in FTT due to the revelations of how closely tied FTT was between FTX and Alameda. With blood in the water and a major investor confirmed to be liquidating their FTT position, investors were trying to take their money out of FTX's platform as quickly as possible, as the relationship between Alameda Research and FTX was way too close for comfort. Now you might be thinking to yourself, okay, the impending collapse of FTT would have created massive losses for Alameda and for FTX. But shouldn't FTX have been able to cover all of the withdrawals anyway by returning the customers' deposits? Well, that's where the fraud really starts to kick in. We haven't even scratched the surface of just how sketchy things get here. Reuters reports that based on interviews with 3 current and former executives of FTX, Sam Bankman-Fried called a meeting with senior managers after Binance announced it was selling its FTT and revealed that FTX was almost out of money. FTX had a $10 billion hole in their balance sheet that they couldn't fill, preventing them from returning customer funds. Shockingly, the employees learned that customer deposits had been transferred to Alameda Research and spent on other assets, which shocked the executives in the meeting. Reportedly, one of the employees told Sam Bankman-Fried that this contradicted what FTX told regulators about its use of client funds. In the meeting, it was discovered that FTX had the ability to sell $3 billion worth of assets, but it still had $7 billion of shortfall that threatened FTX's very survival. With the inability to meet customer withdrawal requests, Sam Bankman-Fried at this point was desperately trying to find any way that he could rescue FTX and stave off bankruptcy. He reportedly called dozens of investors who could feasibly plug the $7 billion hole in the balance sheet, but no one was interested in buying Sam's sinking ship. Reportedly, one of the investors who was approached and had turned down Sam Bankman-Fried said that his presentation numbers were very amateurish. Another red flag the investor mentioned was the presentation showed extensive ties between FTX and Alameda. In the presentation to investors, some of the assets even appeared simultaneously on the balance sheets of both FTX and Alameda, despite Sam's claims that Alameda operated independently from FTX. Investors also saw that FTX had a $161 million loss in the second quarter. Meanwhile, Sam had been spending $2 billion on acquisitions to bail out struggling companies. With nowhere left to go and running out of options, Sam approached his rival and Binance CEO, Changpeng Zhao, about a possible acquisition. On November 8th, Binance would announce a non-binding letter of intent to acquire FTX and absorb the liquidity crunch. The acquisition was set to be completed after a full due diligence process by Binance. Within 3 hours of this news and confirmation of FTX's extensive problems, the price of the FTT token crashed 80%. The collapse of FTT destroyed Alameda's balance sheet in days, since it was filled with FTT tokens that were now almost worthless compared to just days before. But the carnage wasn't over. Literally just a day after announcing the deal, Binance would pull a complete 180 and back out of the FTX acquisition. The company simply said in a statement that, quote, "As a result of corporate due diligence, as well as the latest news reports regarding mishandled customer funds and alleged U.S. agency investigations, we have decided that we will not pursue the potential acquisition of FTX.com. In the beginning, our hope was to be able to support FTX's customers to provide liquidity, but the issues are beyond our control or ability to help." End quote. The bombshell report being referenced by Binance is an article from the Wall Street Journal that reported on what Sam Bankman-Fried had told employees about how money had been transferred from FTX customer accounts into Alameda Research to fund trades. Because of this, Alameda actually owed FTX $10 billion in assets that it had taken. For context, FTX had $16 billion in customer assets, so Sam had taken over half of his customers' assets to fuel his speculative trading with Alameda. Sam's tried to characterize this as a bad judgment call instead of, stealing customer deposits to trade with. Importantly, this was done without customers or even many FTX executives knowing that their assets were being used to prop up Alameda's trading activities. It was also reported that Alameda had outside loans as well and owed $1.5 billion to parties outside of FTX. But wait, there's more. As if that wasn't fraudulent enough, it also came out from Reuters that, quote, "In a subsequent examination, FTX legal and finance teams also learned that Sam Bankman-Fried implemented what the two people described as a backdoor in FTX's bookkeeping system, which was built using bespoke software. They said the backdoor allowed Bankman-Fried to execute commands that could alter the company's financial records without alerting other people, including external auditors." End quote. The fact that Sam built a literal backdoor in the system that was designed for him to take money from FTX customer accounts without triggering any notification to the internal compliance or accounting functions in FTX shows that he knew what he was doing. He wanted to access customer funds for trading, and he was trying to hide it from even other employees in FTX. If that isn't outright fraud, then I don't know what is. And don't forget that this guy's parents are literally compliance lawyers, and this is their area of expertise. So ignorance is implausible. He knew what he was doing was fraud, which is why he was hiding it in the first place. Sam Bankman-Fried also outright lied to investors and downplayed how dire the situation actually was by tweeting this gem before FTX collapsed. FTX has enough to cover all client holdings. We don't invest client assets, even in treasuries. He would later delete this tweet for obvious reasons, but he was right about one thing though. FTX sure wasn't investing their clients' assets, they were gambling them instead. Because of how rapidly it became clear that there was tons of deception and fraud that was happening behind the scenes in FTX, Binance removed its offer to acquire FTX entirely. With no other options, on November 11th, FTX officially filed for Chapter 11 bankruptcy after being unable to find any financing to cover the company's missing funds. Sam Bankman-Fried also stepped down as CEO of the company. Since then, it's become increasingly clear through reports that Sam Bankman-Fried knew that he was acting fraudulently and that his ethical persona was faked. Sam Bankman-Fried discussed the fallout of the FTX collapse in direct messages he thought were private with a Vox reporter who later shared the messages. The way Sam Bankman-Fried talks here portrays a very different image than the golden boy effective altruism philanthropist image he had made for himself. Normally, I would be hesitant to treat these messages as a fact, but this conversation appears to be legitimate, as it was cited by John Ray III, the liquidation lawyer for FTX and Enron, in his court documents. The messages in Vox article were also referenced by the New York Times in an article of their own. And finally, Sam Bankman-Fried essentially confirmed it himself by saying on his Twitter the day that the Vox article was shared that, quote, "Last night I talked to a friend of mine. They published my messages. Those were not intended to be public, but I guess they are now." End quote. So with these private messages basically confirmed as legitimate, let's look at what he actually said. It's frankly shocking the lack of remorse he seems to have for how he defrauded investors in these messages. There's some language in the messages that I've censored so I don't get in trouble with YouTube, but you can fill in the blanks. You can see here that when he's outright asked if a previous answer he gave about ethics was genuine, he basically admits that it wasn't, and that he didn't believe a lot of the things that he was actually talking about in regards to ethics. He ultimately attributes right versus wrong and who the hero versus the villain is to whoever has the bigger balance sheet and more money, which is insane. He then proceeded to map ethics and outcomes to quadrants, like it was all some big game theory to him, and said that losing outcomes were bad outcomes, regardless of whether you acted ethically or not. When asked whether the ethics persona he used was all fake, he outright said that it mostly was, before giving a lip service apology to the people that he hurt in his little game. It paints a very clear picture that the main thing that this guy actually cared about was money and power. And if he was lying about his ethical persona, I have no doubt that he was willing to defraud investors and take their money. He was also confronted by this Vox reporter about the statement in his deleted tweet, saying that FTX never invested customer deposits. The reporter wanted to know if this was all a lie. Sam Bankman-Fried then had the nerve to say that it was factually accurate because it wasn't FTX investing customer deposits, it was all loaned to Alameda who did the dirty work instead. And maybe the most ridiculous part of the messages, though, the reporter and Sam are talking about an FTX employee that had a guilty conscience about FTX taking customer deposits and then losing it all. The reporter then says the employee who felt bad was like, "Wow, we stole money from people who trusted us." To which Sam responded, "The world is never so black and white." That basically comes off as an admission that Sam Bankman-Fried doesn't believe in any objective morality. So it's not a surprise to me that someone who thinks like that would be willing to defraud investors and take their money. Former employees are shocked, with CoinDesk reporting that the former FTX head of marketing said that he and most of the other employees had no idea about the allegedly fraudulent treatment of customer funds. This is similar to other claims former FTX employees have made on social media, as well as reports saying that Sam Bankman-Fried's inner circle had an extreme level of control over the company. The former head of marketing added, quote, It wasn't just that Sam and a small group around him perpetrated fraud, which they did. From the moment the fraud was called out and the market started to react, every single ounce of their effort went into self-preservation. It was callous, cruel, and utterly devoid of any genuine human consideration. End quote. Sam's companies were also reportedly engaging in insider trading. Alameda was front-running and buying the cryptocurrency tokens that were going to be listed on FTX's exchange soon. They did this knowing that the listing announcement for the coins on FTX would cause a spike in the price of the coin, giving Alameda an instant profit since they bought in before the news was public. You can't even make this stuff up. But the bankruptcy filing also says that the auditor for one of FTX's business segments is headquartered in the metaverse. That's how badly they were trying to hide their books from people. Wait a second. It's also not like the warning signs weren't there the whole time, that Sam Bankman-Fried really only cared about money and would be willing to do sketchy things to get it. The guy literally went on a Bloomberg podcast and described the concept of yield farming in crypto, and his description of it was essentially describing a Ponzi scheme. You can't even make this stuff up. Listen to the audio here.
So, sophisticated traders and or people on crypto Twitter or other sort of similar parties go and put $200 million in the box collectively, and they start getting these X tokens for it, right? And now all of a sudden everyone's like, wow, people just decide to put $200 million in the box. This is a pretty cool box, right? Like this is a valuable box, as demonstrated by all the money that people have apparently decided should be in the box. And who are we to say that they're wrong about that? Like, this is, I mean, boxes can be great. Look, I love boxes as much as the next guy, right? And so what happens now, all of a sudden people are kind of recalibrating. It's like, well, $20 million, that's it? Like that market cap for this box? And it's been like 48 hours and it already has $200 million, including from like sophisticated players in it. They're like, come on, that's too low, right? Like, and they look at these ratios. TVL, total value locked in the box, as a ratio to market cap of the box's token. And they're like, 10x, that's insane. 1x is the norm. And so then, X token price goes way up, and now it's a $130 million market cap token because of, the bullishness of people's usage of the box. And now all of a sudden, of course, the smart money, it's like, oh, wow, like this thing's now yielding like 60% a year in X tokens. Of course, I'll take my 60% yield. Right, so they pour another $300 million in the box, and you get a cycle, and then it goes to infinity, and then everyone makes money.
I think of myself as like a fairly cynical person, and that was so much more cynical than how I would have described farming. Like, you're just like, well, I'm in the Ponzi business, and it's pretty good.
At no point did any of this require any sort of like economic case. It's just like, other people put money in the box, and so I'm going to too, and then it's more valuable, so I'm going to put more money in. And at no point in the cycle did it seem to like describe any sort of like economic purpose.
The guy literally described a Ponzi scheme, and he basically wasn't uncomfortable with it at all. Luckily, John Ray III, the liquidation lawyer who was handling FTX and had handled Enron in the past, seems to be very aware that Sam Bankman-Fried is not to be trusted at all, and just how dysfunctional FTX and Alameda really are. He specifically says in the court filing document that he does not trust the company's records from when Sam Bankman-Fried was CEO, noting that, quote, because this balance sheet was produced while the debtors were controlled by Mr. Bankman-Fried, I do not have confidence in it, and the information therein may not be correct as of the date stated. End quote. At the very end of the document, John Ray III straight up disowns Sam Bankman-Fried, saying, quote, finally, and critically, the debtors have made clear to employees and the public that Mr. Bankman-Fried is not employed by the debtors and does not speak for them. Mr. Bankman-Fried, currently in the Bahamas, continues to make erratic and misleading public statements. Mr. Bankman-Fried, whose connections and financial holdings in the Bahamas remain unclear to me, recently stated to a reporter on Twitter, regulators, they make everything worse, and suggested the next step for him was to win a jurisdictional battle versus Delaware. End quote. The reporter John Ray III is mentioning here seems to be the reporter from the Vox article, which would further seem to back up the credibility and legitimacy of those messages. In the first bankruptcy hearing for FTX on November 22nd, an attorney said in the court that FTX had been run as a, quote, personal fiefdom, unquote, of Sam, with $300 million spent on real estate, such as homes and vacation properties for senior staff. John Ray III has also accused Sam Bankman-Fried of working with regulators from the Bahamas, where FTX is based, to undermine the U.S. bankruptcy case and shift assets overseas. All of this is important to know because even though Sam Bankman-Fried and FTX are shaping up to be possibly the biggest fraud of this generation, Sam Bankman-Fried is trying to save face and act like this was some sort of accident instead of deliberate fraud on his part. Instead of saying that he transferred customer funds from FTX to Alameda, he's been characterizing it as some loan gone wrong, saying things like, quote, "I did not realize the full extent of the margin position, nor did I realize the magnitude of the risk posed by a hypercorrelated crash," end quote. But don't let all of the fancy language confuse you from the obvious here. It's an outright lie to characterize the customer deposits he was using to trade as margin, because customers didn't consent to lending their money to Alameda, nor were they aware that Sam was using their money that way. Because no one knew that their money was being used for this purpose, there was no possibility for a margin call either. So characterizing it as margin or legitimate loan is just an outright lie. He literally built a backdoor to siphon money from FTX customer deposits into his hedge fund. If some Joe Schmo built a backdoor into a major bank and was siphoning funds from it, no one in their right mind would be calling that a loan. They would be saying, "Hey, that guy robbed the bank." And yet the media for some reason is avoiding the fraud label to this point, which is giving Sam room to try and create a perception that this was some crazy mistake. I'll let you in on a little secret though. When you build a backdoor to siphon money without anyone else knowing or setting off any alarms like Sam did, it's not some accident or coincidence. It's because Sam didn't want to get caught because he knew it was fraud. And yet the media isn't discussing FTX and Sam Bankman-Fried in terms of fraud just yet. They're still acting like he made a mistake that caused his company to fail. But this was no mistake on his part. When the dust settles, I'm convinced that Sam Bankman-Fried and FTX will go down in history as a major fraud case, along with the likes of Enron, Bernie Madoff, and Theranos. As more and more revelations begin to come out about Sam and his crypto empire through the bankruptcy proceedings, the fraud is becoming more and more plain by the day. Virtually everything Sam Bankman-Fried built, from his public persona to his companies, was all one giant lie that was waiting to be exposed. And that's why it all came crashing down in just days. But let me know your thoughts on FTX's downfall and Sam Bankman-Fried below. And be sure to like and subscribe to the channel for more finance and investing content. Thanks.